everyone. Many familiar names and faces. My name is Sally Andrea. I'm the owner of the Goddard School in Weston. And thank you all for attending tonight's presentation, Financial Tips You Should Be Thinking About Right Now. The Goddard schools in Massachusetts, New Hampshire, and Rhode Island have joined forces to provide monthly educational and informational seminars. And this was spearheaded by Mark from the Goddard School in Middleton, the owner of the Goddard School in Middleton, and it's been really a great experience. So on behalf of all the Goddard School owners, we thank you for continuing to attend, and please stay tuned for future seminars. So at this point, I'll turn it over to our very own Goddard parent and financial advisor, Heather Yetman. She can introduce herself, as well as Ben Hamlin, who has joined her for today. Heather, it's all yours.
Thanks, Sally. Hi, everybody. Some of you may recognize me. I go to Sally's Goddard School in Weston, Mass. I have two boys, 2 and 4, that are there right now. And as Ben Hamlin's a colleague of mine, he also has a son, Hunter, who's 3, doesn't attend the Goddard School, but kind of is in the same phase as all of us. So, you know, tonight we're going to talk about a lot of high-level things in terms of your financial well-being, steps to take, where to start. You know, as all of you probably know, you can go on Google and you can get lost in different investment management firms, different insurance companies, what to do, what's the first step. So tonight, we really just want to give you all kind of a blueprint, where to start, what kind of questions to ask, where to get going, so that you feel you can take control of your financial well-being and take the first next step. So I put in the chat my contact information. If you would like to get in touch with me, please, you know, there's my email, my cell phone. We know sometimes it's uncomfortable to ask questions in this type of environment. So of course, or if you want to talk personally, you know, please follow up with an email. Sally also will, or you can send it to me if you want to send us your email via the chat for me to reach out to you, just to make it easier on you. You can do that as well and share that with Sally or myself, and we'll do a follow-up email after this. I think everybody is unmuted, so either if you have a question during this, you can either raise your hand and Sally will unmute you, or you can put it, you know, in the chat to Sally and she can ask us the question, and then at the end we will have plenty of time for question and answers as well. So the first steps that we want to talk about, and we're going to cover all of these in different in the next couple of slides. These are just sort of things that we start talking about with families that have young children. I think that it can get really overwhelming for a lot of parents, and you know, what do I do now? And these are the first steps we talk about: budgeting, managing your debt, retirement planning, looking forward to the future, your investment accounts, insurance or protection planning, and then taxes and estate planning. So just to get right into it, you know, the first step we talk to all of our clients about, and, you know, especially with young families, is establishing a budget. Some people may already have one, you know, work off an Excel spreadsheet. That's great. Some people may feel overwhelmed by this exercise, but I think that it's very important to start some form of a budget, whether that be, you know, just starting every month by keeping track of what your credit card bills look like. The reason we look at a budget is because it allows us to see, where are you saving money if you are? And if you're not, are there places that we can look at that we can make changes, such as some of your debt you're paying on a monthly basis, that you can reallocate some of that money to savings to establish and build some of the goals you want to achieve. But you never know where to start until you know what your budget is every month. So we always talk to clients about looking at your finances, talking with your spouse about what does it look like every month, and where are there ways that you could possibly save money. The first thing that we talk to all of our clients about is establishing an emergency fund. You may have heard of this before. The recommendation right now, especially during COVID, where there's unpredictability of things such as your job security and where things are going to be next, we always talk about emergency funds in the terms of keeping cash reserves about 6 months worth of your living expenses. This is in case something happens, in case one of you loses your job. We talk, you know, we want to make sure that there's a safety net, that there's money you can take right away that's liquid, that you can pay all your expenses from. So if there's anything that you take away from tonight, I would say this is the number one thing that I recommend is building your cash up in your, just in a Bank of America account or wherever you keep your banking, worth of 6 months of your living expenses, just to have that security in case you lose your job or your spouse loses a job or something unexpected happens. And during this budget, what you really get out of it is figuring out what are you saving every month, or how much do you want to save every month to establish your goals and build on your goals. So a budget really looks at where is that extra money, if there is any, and how much is it, and then we can talk about next steps of where do you allocate that. So the next step we talk about is setting your goals. I think this is a really good exercise for spouses to sit down and discuss what your goals are. You might have different goals that you haven't talked about, things as short term as we want to upgrade our house to as long term as, I want to retire at 65, maybe move down to Florida. What does that look like? So really looking at what are your goals and putting them on a piece of paper allows you to then efficiently save for those goals. Then it lets you put a plan in place to say, here's what my goal is, here's what I want to accomplish, and how are we going to get there? So really during those, during this discussion, it's what are those goals, and then how are you going to save to them? But then we also look at, and we'll get further into it, is as you put a plan in place for a family, there's a lot of things that are unpredictable. We love to say that you can put a plan in now that's going to be perfect until you're 65 and you retire, but realistically, that's not going to happen. So being able to have a plan in place now and have those goals set up now and start saving towards them allows us to kind of make sure as time goes on, as things change, you still have a plan in place. You're still following what you want to accomplish. So things like protecting your income with things like disability income insurance and other things kind of helps you stay on track. So what you look at is kind of, and what, help with when you work with a financial advisor or financial planner, if you choose to do something like that, is really looking at what will that goal realistically cost you? And then how much do you need to save towards that? And then what can you be doing right now to be saving for that money? Things like cutting your budget in certain places or reallocating some assets depending on where you're spending them. So I'm going to pause for a second. If there's any questions, raise your hand or put it in the chat. Otherwise, we'll keep, and Ben, I don't know if you want to add anything so far.
Yeah, no, I'll wait and see if anybody has any questions. I mean, my main thing that I would just add is, in sort of career development in each one of your careers, you probably hear the philosophy around setting goals, or, even if it's outside of work, if it's, health and fitness, or, it's setting a goal is how you sort of achieve something. And it's really no different in finance, right? Is having goals, writing them down and focusing on them is how you actually get to those destinations. So while it can seem elementary in a sense, it is very important. But if anybody has any questions or thoughts, please feel free.
Okay. So our next topic is debt. I'm not going to really get into much depth of that right now, but sort of keep it on a high level. As many people probably have heard, there's good debt and there's bad debt out there. Good debt is things like your mortgage, allows you to live in a home, build equity in your house, be able to continue to pay for that. There's other ways that we look at restructuring debt, such as credit card debt. If you have a credit card that you continually keep your balance on, some of those credit card debts can be 20% interest rates. You're paying that extra money towards that. So things like that, restructuring your debt, I would be looking at, are you paying high interest rates on certain things like credit cards? Are there ways that we can set a goal to putting money towards that each month until you pay it down, so you don't have to continually pay that interest, and reallocate that interest money that you're spending every month, to a different goal? Student loan debt. A lot of people have student loan debt. Are there ways you can consolidate, bring it together, make it easier for you to pay those bills monthly and keep track of it, but also possibly consolidate and lower your interest rate on that? So these are types of things that are discussion points that a lot of us have at this age in our life. We've just come out of colleges and we're just building up and we want to get prepared for the future. So ways that we can, look at being able to restructure our debt and make sure we're spending the right money on that. All right. Ben, you want to take over from here?
Yeah, if you don't mind, since I think you're controlling the PowerPoint, I'll have you go to the next slide. But Yeah, so Heather and I in advance of preparation for this session tonight here, we're drawing straws, and I drew the insurance straw. Lucky me, but all that aside, it is important, right? It's one of the things that we'll say to people when we're working with them, or just people who are consulting with us in general, is our job, we feel like with our clients, is to really, hope for the best and plan for the worst, right? And the idea of having protection in place is, if something unanticipated happens, we have a plan in place, right? And it's no different than cash reserve that Heather was talking about. A cash reserve is a defensive play in the event that you need it. And one of the things we talk about as it relates to protection, that's paramount to everything else, in our opinion, is income protection, right? And income protection against disability. And disability, as we'll mention maybe in a little bit here, isn't necessarily in a wheelchair, right? It could be a variety of different things that cause you to be unable to work. You may have influence over if you become disabled, but you don't have control, right? So allowing us the ability to sort of make sure we've checked the box of if something were to happen here, do you have an ability to keep the household afloat and all the necessary expenses afloat? Most people have group coverage through work. Not everyone, self-employed people don't, and other individuals may not, but many employers offer group coverage. Generally speaking, if you go on a claim, the benefit is a taxable benefit, meaning that if your amount of group disability benefit is $3,000 a month, you're going to be taxed on that income, right? So that's when the employer is paying for the benefit for you. If you procure supplemental private individual income protection, then what that is it's tax-free if the benefit pays. So if for some reason you go on a claim, you had an individual policy of $2,000 a month, your group policy of $3,000 a month would pay, it would be taxable. Your $2,000 a month of individually owned supplemental coverage would not have a tax applied to it. It would be a tax-free benefit. The most important asset that you all have, in our opinion, is your ability to go out every day or go to your Zoom screen every morning and earn an income, right? And I think it's difficult sometimes for people to wrap their heads around, hey, if we said, what's your most valuable asset? Some people would say, well, my home or my 401k, right? But the answer is your ability to earn income. And if Heather goes to the next slide, it'll start to illustrate that a little bit. Obviously, you can do the math for your own individual situation for you or your spouse. But if you just take your income that you're making now, assuming no income increases, which we all hope and expect everyone here will get, and you multiply it out by the number of years you expect to continue to work, it's reasonable to see incomes that are $5 to $10 million plus that will be earned in the future, right? And if we all were asked the question, hey, would you want to make sure you insured a future value cash flow to your home, to yourself and your spouse and your kids of 7 or 8 figures, I think most people would say absolutely, right? People that pay insurance for their iPhones, right, would want to insure their income. So we obviously sort of surfaced the thing, and the fact that most people don't have an awareness that their group benefit at work isn't sufficient to cover their expenditures at home. And we're not talking about going on vacations in a pre-COVID world or going on and spending frivolously. We're talking about meeting the mortgage or the rent, groceries, childcare costs, basic necessities. A lot of group policies will not be sufficient to carry those things. Statistics would show, and you can see sort of the sources here down at the bottom, I won't quote them, but 1 in 4 healthy 20-year-olds will become disabled for a period of 90 days or longer prior to their age 65, 1 in 4. Whereas 1 in 20 will actually pass away before age 65, right? So there's a 5 times higher likelihood someone experiences a disability of 90 days or longer where they can't work than that they would pass prematurely. And to the point we sort of shared earlier, most of the times where we think about disabilities, we think about somebody, losing a limb or having a stroke. It's 95% of disabilities that occur outside of the workplace. And a vast majority, the largest majority of ones that occur are not necessarily physical disabilities, but rather sometimes mental disabilities, right? So it's important to just make sure while you're healthy and while you're in a good position, making sure that you lock in protection on your income, because everything else in your financial world that you're building toward, as Heather mentioned, goals, whether it's, real estate, whether it's putting money in a 401k, putting money in a 529 for your kids' college education, everything else that you're doing, retirement, is going to fall apart if you don't have an income protected that goes away, because you'll withdraw from your 401k, you'll take it cash out against your mortgage, You'll pay IRS penalties on Roth IRAs in order to make sure you meet the cash flow of today. So you just want to make sure you're putting yourself in a proactive position. Go on to the next slide if you don't mind, Heather. Life insurance, right? We all probably know a little bit more about this. It's more prevalent than disability or income protection. But really there's just two specific ways we look at determining what's the right amount of coverage someone should consider. One is what's called the human life value need. Now, I'm sure everybody on the room, your spouse would say you're priceless. You can't possibly assign a value to your life. But for purposes of an insurance company looking at how much they would insure you for, roughly what they do is they take your income and on a multiple of years you have up until age 65. So let's say somebody was making, I'm just pick a round number here, somebody's making $150,000 and they're going to be working for another 20 years, roughly. That person could probably go get about $3 million in total life insurance coverage. That would be their economic life value, their human life value. The second way to calculate a need is specifically what it sounds like, a needs-based calculation, which more backs into a number that would recreate what the person would want for the surviving spouse. And that really starts to account for, all right, what's the percentage of the income that you bring into the household today that you'd want to make sure is there for the surviving spouse and any children? If you have debt or if you have a mortgage, would you want to have that thing paid off? Okay, we want to factor that into calculations. Is there anything else that you'd want to make sure was factored in, such as savings for education that's happening now that your income is a driver in allowing that to happen? So we can basically back into a goal-based number that would say, okay, in order to recreate those things, here's the amount of coverage you would want to apply for. Once we know the number that you'd want to have, which is the most important thing, then we could determine the type of coverage that's most suitable. There's a variety of different types of life insurance. Predominantly, there's two types that we usually educate clients around. One is term life insurance. It's really like renting a home, right? It's lower cost. You don't build equity. At the end of the term, just like at the end of the lease, you don't own anything. You walk away. Everything you put into the policy is sort of gone. But you have the protection during the term that in the event something happened, you're covered. Permanent insurance, much like owning a home, it requires more capital, right? But there is an element of building equity inside of the policy, just like you build equity inside of a home over time. There's tax advantages to owning a home. There's tax advantages to owning permanent life insurance. Really, it's difficult for us to say on a large, high-level scale what would be suitable, because it really depends on the individual circumstances what's suitable. All we'd say is that predominantly you want to make sure life insurance, the role it's playing is protection against the catastrophic. And then to the extent that we can blend in some permanent coverage, it just increases the likelihood that if what we expect to happen happens, which means you outlive the term, you have money and future benefits and capital there to show for it, because along the way you carried some permanent to sort of supplement the term that you had. I think that is a variety of the, maybe next slide, Heather, just to make sure I'm not wrong, but if that's most of the, well, I'll hit this one and then we'll ask if there's any insurance related questions. We obviously have earmarked time at the end for questions, but the last thing we sort of focus on from a protection standpoint is protection on assets, right? So we have things like renters or homeowners coverage, maybe dusting off some of those things and making sure you're adequately protected against some things. And then auto insurance, making sure that you're covered for purposes of, whatever the deductible is, and knowing the limits of liability that you carry, right? And if the limit of liability is up to just the state minimum and something were to happen and you were to be in an accident and you were found at fault, again, these things are all unlikely, but if we're planning, we have to plan for the unlikely and hope that it doesn't happen, but still plan for it. And you were sued for an amount above and beyond whatever you were covered for, they can come after wages and come after other assets in order to recoup inside of that lawsuit. So you just want to make sure you're consulting with a professional. We have these conversations with our clients as it relates to specifically auto, homeowners, renters, umbrella coverage. We usually will introduce you to somebody that's sort of directly licensed to handle those conversations. But it's still part of the conversations that we have because it matters within the collective whole of someone's personal planning. Any questions from a protection standpoint at a general level? And we can obviously come back to questions at the end, but I want to make sure, like Heather gave a chance for questions, I do the same. Cool. All right. So we'll get into just a little bit more around sort of investing and retiring. And well, some of this may sound or feel or obvious. It's super important, which is why we voice it. And I think finance is one of those things that we all recognize as important, but it isn't necessarily the most important thing, right? And when I say the most important thing, I don't mean money's the most important thing. I just mean in the day-to-day of our lives, we have other things going on. We recognize in the backdrop finance is important, but it's not something that necessarily we pause and say, hey, wait a minute, I want to make sure I'm proactive in getting this under control. And if we don't do that, what happens is time goes on, situations happen, and then we're forced to deal with it. And normally if we're forced to deal with it, we're in a position of reactivity, which means we're on the defensive, which means probably not a good thing, right? So one of the things that we can really do to be as proactive as possible, other than putting good protection in place, is to start saving and saving early and saving systematically. When we say systematically, it isn't, oh, hey, I'll save here or there when I can, because that usually lends itself to I'm spending. Oh, wait, hey, there's a little extra money here for my bonus. I could save this, but making sure you're working savings in almost as a bill, right? A line item in your budget. And sort of we're coaching people all the time around these 3 or 4 points here, and more so the last year than I can remember in my career. Maybe just when I started my career back in the late 2000s was the only other time that rivaled this, but maintaining realistic expectations around market performance and returns. What can you expect over the long term, right? And last year we had clients that had insane returns, right? Either in portfolios with us or in their own portfolios. And last year was just, as we can all expect and sort of recommunicate on, a crazy year, right? And it's not representative, hopefully, of years going forward as it relates to what we can expect sort of globally and in the markets and everything. So we want to take a long-term approach. If we're investing for retirement, as an example, for most of you with younger kids in school, it's probably a little bit of a longer-term goal. But some of you may have an aggressive goal of retiring at 40 or 45. We work with clients like that too, so I don't want to speak for everyone. But avoid the temptation of the time markets. We talk a lot about, it's about time in the markets, not timing the markets. Timing the markets can be a very, very difficult thing. There's studies that have been done. We can share them, with anybody that would like to see, that sort of goes back in time and sees flows in and out of the markets at different points in time based on when the markets were going up and when the markets were going down. And by and large, a consumer that tried to time the markets was doing 2 to 3% less year over year in average annual return versus someone that just bought and hold, right? And just sort of stayed invested. And lastly is diversifying. And when we say diversifying, it's not just about owning a bunch of different asset classes. It is that, it is spreading out your risk, but it's also diversifying from a tax standpoint, meaning the way that your assets will be taxed when you go to distribute them, having certain money that is in, something that gives me tax deduction today, but I'm going to owe ordinary income tax in the future. Another bucket may be, a bucket that allows me to gain some money in a brokerage account today, but I may pay capital gains in the future, but sometimes you can offset gains and losses along the way to limit your tax exposure if you're working with somebody that can help you there. And then lastly is tax-free, which is how can you save money that when you go to access it in the future, you're not taxed on the withdrawal. Make sure you have tax diversification. And lastly is just time horizon diversification, depending on different goals that you have. They're short-term, medium-term, and long-term goals. You want to have, sort of a mindset of liquidity and conservatism for those shorter term goals. A little bit of, sort of a moderate conservative sort of play for medium term goals. And then obviously, if you're younger and you're looking at longer term goals where your risk tolerance is allowing you want to make sure you're taking good risk, because over time, more risk generally equals better return. All righty, go right ahead if you don't mind, Heather. I just touched on it briefly, so I'll be really brief here. Some of these numbers are a bit dated, so if you want the specific numbers for 2021, please let us know. But 3 primary tax buckets that the IRS classifies for purposes of saving. One is a Roth IRA. The money goes in after tax. There's no tax deduction on the contribution. But so long as you've held the account for 5 years and you're over the age of 59 and a half, all of the money, both the principal and the growth, is withdrawn entirely tax-free. You can only contribute up to a certain, or people that earn at or below a certain number of income are eligible to contribute to Roth IRAs. If you're making over a certain income, they start to phase you out, and eventually they won't allow you to contribute to a Roth IRA. Certain employers offer a Roth 401k, not a lot, but certain ones do. Regardless of your income, you can contribute to a Roth 401k if your employer offers it. Traditional IRAs, these are things like, just a normal pre-tax deduction on the contribution I put in today. So if I put $3,000 into an IRA right now, I can deduct on my 2021 tax return next year, $3,000 from my income, right? Now, I'm going to pay taxes on that withdrawal in the future because I took a tax deduction today. But you know, there's an ability for somebody to save money and shelter some tax here and now for retirement. 401k and 403b, the primary reason you see those are more prevalent is number one, they have higher contribution limits. You can put more money into a 401k or 403b than you can in an IRA. And oftentimes employers will incentivize employees to contribute to these plans by offering matching components, right? Well, a percentage of your income, or they'll match a certain, 50 cents on the dollar up to a certain percentage if you contribute. So it's obviously a great vehicle to save for retirement. The problem is, if that's the only place you save for retirement, what will end up happening is you're going to have a very, very highly taxed retirement income plan, right? So that's part of the reason we want to have you tax diversify. Cool. I'll have you go to the next slide. I'll apologize as she goes to the next slide. Our building security alarm system's going off right now. So if you can hear that in the background, I apologize. I'm just going to stay right here and give this seminar. So if I go down, make sure they play this at my funeral. All right. So we talked a lot about saving, but when and how much. And the most important takeaway is now, right? Is to really sort of, Heather mentioned, do an assessment of your budget. It's always a reason to wait. There's always a reason to wait to save more money. We say as a rule of thumb, 15% of your annual gross income is sort of a good level to create financial independence in the future for yourself. So if you take that same $150,000 household income and we just say, hey, you know what, as a ballpark right now, if we're saying $22,500 a year, just shy of $2,000 a month, is a good number for that household to be saving right now. Not everybody's there. If you're not there, it's okay. Over time, we can get you there, or saving even 2% more than you're saving now is a step in the right direction. It's progress, not perfection, right? That being said, and we'll share a slide that gets into this in a moment, the longer you wait, one of two things is going to happen. Either you're going to be forced to save astronomical amounts of money to give yourself any kind of shot at retiring the way you want to, or you're going to have to continue to work for a longer period of time. Depending on the income desired and some other factors, really depends on what you need to save, how much you have saved already, when you want to retire, what your goals are for retirement. What I would urge all of you to do is to not make the mistake of certain people that, I've seen and spoken to the extent that you do nothing else other than just take action within your own personal financial situation offline. Start to put yourself in a position that you're saving more. And the main reason I say that is because people will bargain away their future for purposes of being okay today. And what I mean by that is, well, retirement's a long ways away. I'll figure that out. And, I can always save more when the kids, leave. The kids are just so expensive, that I eventually am going to be able to save more money. Or, what, in retirement, we won't need much money because we won't really be traveling that much or doing much. I can tell you about clients that I have that have retired, and Heather has, that are retiring or in retirement, that want to and spend as much money, if not more money, than they spend in their 40s and 50s because they have free time, right? They have grandchildren. They can travel outside of a pandemic, and they want to be able to do some things that they never were able to do when they were working. Think about it. When we spend the most money now, usually, is on the weekends or on vacations, right? During the weeks we're working, we're not spending money other than basic necessities. So just making sure that you're not shortchanging your future self at the expense of enjoying life today. And it's not to say don't enjoy life today. Money should create a lot of enjoyment for you today, but make sure you're also addressing your future self as well. Cool. Just to kind of illustrate, the importance of saving now versus saving later. There's two individuals here. Dan up top, as an example, when he's 21, he contributes $2,000 every year to a Roth IRA, and then when he's 31, he stops. Assuming he gets an average 8% rate of return, his account balance, which we'll see in a minute. Actually, I think if you hit the thing, it may give us a balance. There we go. He's put $20,000 in, his account balance is $500,000. Karen, on the other hand, waited to save until she was 37 years old. She contributes the same $2,000 every year, but she does it for 30 years, not 10 years, from 37 to 67. So she's put in 3 times the principal, but her account balance at age 67, assuming that same 8% annual rate of return, is half of what Dan's was. So a third of the money invested early resulted in double the money later on. So it's just to show you the power of compounding, the power of allowing your money to work for you for a longer period of time, and the power of not deferring. And even for all of you that probably are saving now, the question isn't necessarily, hey, start saving. The question is maybe, could you or should you be saving more? And are you saving to the right places? Right. And those are kind of the things that we can help you with, or that you can sort of take some time within your own households to hit the pause button every now and then and start to have a conversation. Last slide on sort of investments, or second to last slide on, is just illustrating this another way. If we were saying $1 million used to be the gold standard, it's really not now. $1 million when we're all 65 isn't going to be a whole lot of money. But to amass $1 million by age 65, if somebody started saving $308 at age 25, did that every single month, they'd have $1 million at age 65, assuming an 8% rate of return. If they waited to 35, they need to save $705 a month. They waited till 45, they need to start to save $1746 a month. If they wait till 55, then it's a nice mortgage payment that they have to save, right? So at the end of the day, this just illustrates, if you start doing a little more now, can make a big difference later on, versus if you wait a little more when you're in your 50s, isn't really going to be much at all. Lastly, sort of on my front here is, we heard Heather talk about it a little bit, but the idea around investing and paying debt. Really what we do is we come back to the idea of good debt versus bad debt. And one of the biggest things that we advise people on when it comes to, is debt a good debt, is the interest rate associated with it. And it's this idea of leverage within our own personal situation. So companies, Apple, Amazon, Google, they all have debt on their balance sheets. It's pretty smart companies making money, but they see a reason to carry debt on their balance sheet right now. Within our own personal situations, we don't want to carry credit card debt, or we don't want to carry high interest rate personal debt, or even high interest rate student loan debt. But to be able to have a low interest rate in today's interest rate environment, where you might even want to look at refinancing if you haven't already, and you can get rates in the 2s and 3s on the mortgage that you have. If you're prepaying that debt, what you're doing is you're saying, you know what, I'm going to put money towards getting rid of this thing that's costing me 3% every year, that I could instead be putting towards something that might gain me 6, 7, 8% every year as an average, right? And that delta of 3, 4, 5% becomes pretty dramatic over the course of maybe a 10 or 15 year aggressive debt pay down schedule. So, when we're advising people, normally we want them paying down aggressively debts that carry high interest rates, debts that are costing them more money when we look at the collective whole. But we usually try and coach people where possible and where they're okay with it, to pay the required principal and interest payment on their mortgage, on maybe even a 30-year fixed, but to not prepay the principal on that good debt down, but rather recoup that, what would have been lost opportunity cost, to grow an asset further, to allow yourself the ability to have more in the end. Cool.
And just before, I was just going to say, that was great. Thanks, Ben. Before we move on, I think to take from this, I think the most important thing right now any of us can do is start saving something every month. And as Ben said, just because you don't think it's a lot right now, it's more about doing the systematic saving and starting to build your assets now, and getting into the strategy and into the habit of saving every month, so that as time goes on, you already have that account set up, you already have that direct deposit going, that you can continue to increase it as your earning ability goes up. And it's just getting into the habit of saving every month, which will really benefit you in the long run. And even if you think it's a little amount now, it's the time value of money. Being able to invest your money over the long haul is really what we're looking at, rather than how much can you put out, every month. So just to kind of close out, and I would say, even though this is the end of it, I would say this is probably one of the most important things that we instruct families with young children to do, is to work through estate planning documents. There's a lot of attorneys in the area. We can connect you with some if you don't have it, who can help you, what we call, set up your basic estate documents, your will, your living will, your healthcare proxy, and your durable power of attorney. These are different documents, and we don't have to go in all depth, but basically what these different ones do, allow you to, and what is so important is to put out your wishes for if something were to happen to you. So for example, your healthcare proxy allows you to choose who's going to make your decisions. If you are in the hospital and no longer can make your own decisions, you get to decide who that is, not the law, not who they'll appoint to you. Your will, your living will, also allows you to, your medical treatment. How do you want it to be handled if you are on a ventilator? What are the next steps? Again, it allows you to make the decision. It doesn't have to, one, do something you don't want have happen, but also to put that pressure on your spouse or your parents or whoever may be taking over of having to make a decision of what you thought you wanted. Your trust, setting up things like guardianship for your children. I know it's a hard conversation to have of who would take your children if something were to happen to you both, but you'd rather have that conversation now with your husband and make that decision than the state make that decision for you. Or, it gets tied up in some courts before you can actually make the seamless transition for your children to move in with somebody. So these are just things because it allows you to keep control of what would happen if something were to happen to either of you, and you keep control of how that works. Is why we think it's so important to put it in place, because you want what you can accomplish. So these are things that a lot of estate planning attorneys can draft for you, and you can amend as time goes on. We've seen clients who get down into the depths of their estate planning documents that say, something were to happen to me, I want to make sure my kids can play soccer every month or every year, or we want to make sure that they can go visit their grandparents in the summer. And so you can really get detailed about what your wishes are. But I think most importantly, it allows you to have that conversation and be able to put those things in place to make sure that your wishes are followed through if something happened to you guys. So on that's sort of the end. Our favorite thing is people don't plan to fail, they just fail to plan. So these are just some tips we wanted to make sure that we covered. Again, very high level. We kind of covered a lot tonight. So if you're feeling a little overwhelmed, we get that. There's a lot to be covered. But we wanted to give you an understanding of all the different things in your financial well-being, not only that we can help you with, but more just to think about, to start understanding, start learning a little bit more about. We have time now for question and answers. So if people have specific questions they want to talk about, you can either throw it in the chat, or you can raise your hand and Sally can unmute you. Or also my contact information is in the chat. So feel free to reach out to me at any time if you want to, go through something more in depth or cover something that we discussed today, or feel free to send me your email and I'm happy to reach out to you as well as a follow-up.
And the only other thing I'll add, and then we can take any questions if you have them, is just, sort of taking the professional hat off for a minute is, everybody's situation is unique. Right. But Heather and I, probably have a lot of things going on in our lives that are similar to a lot of you. Right. And with, young kids and, working spouses and managing through a pandemic, and, everybody's situation is unique. But, we're not, 60 years old with kids out of the house, and if there's things that we can relate to, or, we can certainly relate from a human standpoint, I think, to a lot of the things that you guys go through it. And that's obviously, trust and relationship is paramount when it comes to dealing with finance with anyone. And the idea that to the extent anybody wants to sort of have a further conversation and figure out if there's sort of a mutual fit there, Heather and I will be, we're going to be doing this for a while. It's not like we're 58 and going to be retiring in 7 years when you guys are entering your prime earning years, right? We're going to be doing this for a while. So, but I just wanted to add that and see if anybody has anything that they would like to add on their end or questions.
So there is a question in the chat. Oops, my kids just came home. Did you hear that?
Oh yeah.
Yeah. A little, they were excited about the question. Okay, so the question is, do you recommend using a traditional college savings or also doing life insurance to save for college? So the question is, would you recommend using a traditional college savings plan or also having an insurance plan to save for college?
Do you want to take it, Heather, or you want me to take it?
Sure, I'll start, and you feel free to jump in. I think it's obviously unique to everyone's situation and what they're planning for. A college education savings account is a great way to save for your future, for your children, for their education. For those who don't know about it, essentially what you do is you put money into it, and if you, as it grows, when you're ready to take the money out, as long as you're using it for higher education, and it now can be used for high school education, K through 12th actually, as long as you're using those funds for educational purposes, you don't have to pay any taxes on the gain of what is in that account. So it's a very efficient way to save for college because it allows basically your money to grow and you have that access to those additional funds. So I think it is a great way to save. We recommend to a lot of our clients, if they have the ability to do it, put some money in there. But yes, we do have clients who also look at insurance as a way, whole life insurance as a way to potentially fund that in the future. And so I think it's really based on your personal situation and the need for life insurance in other aspects of your life, and not just for, we don't recommend it just to get it for spending for college. But if it's something that you need anyways, that's a discussion we can have. Ben, I don't know if you want to add anything else on that.
Yeah, no, I completely agree. The only thing I'd add is just when we're making recommendations, we want whatever money decisions a client's making to have flexibility built within it, right? And a 529 plan is absolutely a fantastic vehicle. And, now allowing sort of the K through 12 usage of it makes it more beneficial. Previous, when it was college only, it's like, well, what if your child gets a scholarship, right? Then all of a sudden you're paying a 10% penalty on the 529 distribution. So absolutely, I think it is a way. I almost subscribe to the theory of there's a variety of different ways to help pay for college. 529 plan is one of them. Life insurance can be one of them. The flexibility that offers is you can use it for school. In the event that you are looking for financial aid, it's not counted, right? Whereas a 529 is a countable asset. But in the event that you didn't want to use it for college, like you could pass it on to your child and allow them to sort of have an asset that's building for retirement, or, sort of start out with some life insurance. So there's multi benefits to that. And then even something like a brokerage account could be for helping your kids with education, could be for retirement, right? Who knows, a lot's going to change in between now and when your kids go to school potentially. And it could be that you're able to fund some of for education out of cash flow. Could be some that you're able to use some equity in the home to fund some of it. And it could be that the landscape of tuition comes down dramatically over the course of the next 10 years. And maybe it doesn't cost 70, 80, 90 grand a year to send a kid to school every year. It may cost still in some pockets for the Ivy Leagues, right? But I just think there's a lot of unknowns that flexibility is usually what we're advising on. I hope that helped. I think Sumar has his hand raised, unless that was
Yeah.
right.
I was looking to see if did I do it? Yep, there we go.
Okay.
Summer?
Hi, Samar.
Sorry, using my wife's account. Hi, Heather. Hi, Ben. Thanks.
Yeah.
Can you hear me?
Loud and clear.
Yep.
We got.
Okay, so two questions. One is, I was sort of struck by the statistic about recommending trying to save 15% of your annual gross income. So sort of, it was definitely easy, when my wife and I were a pair of dinks. So what's sort of the recommendation, if you have like 2 young kids and it sort of feels like your expenses are at its highest right now, so that's difficult to sort of hit. It is sort of transient. So I guess what would the recommendation be when you feel like your expenses are at its highest? And the other has to do with 529As. Sorry, my son. What's the best way to research rates for 529As, or where to set it up?
Go ahead, Ben.
Sure. So on the first question, yes, absolutely. So it's easier to save before having kids. A lot of times what we find is people don't really do a great job of that, just because they're like, well, it's more fun to spend than it is to save. But some people are disciplined. Like we sit down with people in their late 20s that save really, really well. But yes, it is all of a sudden there's childcare costs, 1 kid, 2 kids, 3 kids, camps, clothing. There's a variety of different things that factor into the cost. So the ability to save sometimes can at least decrease. It's not that it necessarily goes away, but it's like, hey, before we're saving this, and now we're saving less. The things that would hopefully help mitigate to that are areas in which you can obviously work to expand on your income. Obviously, I know some of that sometimes is outside of our control, but the ability to sort of be able to get into pockets of earning more. But it's really just being efficient in some of the things that we share early on as we start to work with somebody is, all right, let's try and understand where you're putting money right now, where your cash flow is going. And we're not looking to take away Starbucks in the morning. We're not looking to take away things like that. It's more just like, where could we maybe be a little bit more efficient with cash flow? And the 15% number, while it is sort of a bar that we want people shooting for, a lot of times we'll sit down with, a couple that's saving, I'm making it up, right, 3% of their income. And, when we enter into sort of like I'll say exit the onboarding phase and we enter into the ongoing phase with the client, they're now saving 6% of their income. And that's cool. That is great. That's tremendous, right? We should celebrate that. And really over time, what happens is hopefully there's income increases that happen. And what we try and dial it up as is like when an income increase happens, we talk and we usually say, all right, a third of that money you should go spend and enjoy, lifestyle enhancement. Let's just assume a third of it goes to federal and state income taxes, but the other third of those income increases, let's try and save, right? And if income goes up by $10,000 in a year, then there's, $3,300 there per year, or just shy of $300 extra a month that you can start saving that doesn't hurt your cash flow at all because you didn't have it the previous year anyway. And that's how we, over time, can work closer to that 15%. And then just real quickly on the 529 plans, it's a great question. Happy to talk more offline about it. There's different benefits to different 529 plans. The returns that you're going to get are really a representation of whatever fund you're in, meaning, is it a target date fund aligned to when your child may go off to school that sort of reallocates itself to become more conservative as your child gets closer to 18? Is it more a specific fund that's like a large cap equity fund that takes more risk, or a bond fund that takes less risk? The state plans, the ones that have certain states associated with them, if it's a state of New Hampshire plan or a state of Massachusetts plan, right? It allows for no tax, I'll say no taxation on the state level for the distribution, and or depending on the state, a tax deduction up to a certain limit on the contribution. So 529 plans can get a little bit sticky as it relates to what state are you talking about, what state might your child go to college in, where is your residence. But as it relates to the rates of the performance of the actual 529s, it usually just depends on the fund that you would invest in. I don't know, does that help you some? Heather, anything to add?
I was just going to add that while we're on this, another question that came up for college savings plan was the effect that it has on scholarships and financial aid. So kind of there's a lot of factors that will play into place, but if your 529 is owned by the parents, it will be included in their investment assets at a small rate. However, depending, the FAFSA forms, the financial aid forms that are filled out are dependent on also the income of the parent. So there is potential that depending on your income, it won't even be included, or it could be included in a small amount. So it really is kid specific. And then also on the basis of the withdrawal, the income that comes out that pays the college is not included as your income or your kid's income. So that also helps in the financial aid place as well. I don't know, Ben, if you have any more to add on that, but that sort of high level kind of addresses that, I believe. No,
absolutely agreed. And when it comes down to the specifics of, there's a lot of things that we'll do with folks. And one of the things sometimes people hire us for is, a really good education planning, like around our kids' education. And then we get very tactical as it relates to, what is this potentially going to look like? How much do you want to fund? How would we like to fund this? And then we build this customized savings plan based on all the situations, or I should say all the details of your specific situation. So it's more difficult, as you would expect, to make a blanket recommendation. It really is sort of a one size does not fit all. It's customized to your situation, your goals.
Does anybody else have any questions? I know we're coming up close to 6:30, so want to be respectful of everybody's time since I know we all have young kids. But is there anything else that anybody wants to ask? As I mentioned, you feel free to send me, Ben or Sally, your email directly if you want us to reach out to you. We're happy to have a conversation going more in depth on your personal situation and any of these questions. Or if there's something you don't want to ask right now, we're happy to have a call offline to answer it for you. I will just share one more time our contact information in the chat. So emails and phone numbers, so feel free to reach out if you have any questions. Sally, is there anything else you want to add before we end?
We're going to be sending a recording of this out. So if anyone wanted to watch it again as a refresher or forward it along to someone else, we're going to be doing that. So just stay tuned in the next couple days.
The only other thing I'll add, just you guys all took a good step, this evening of hopping on this call. We're probably balancing some kids behind cameras, but take that first step is a great step to take. And To the extent that taking a second step is something that you guys want to do, we're happy to chat and see if there's anything that we can do to be a resource. And if nothing else, I hope that this allows you guys to pause within your households and start to really put yourself on the best financial path you can. Thank you for spending time with Heather and I tonight, and thank you, Sally and Mark, for having us.
Yeah,
Thank
thanks
you.
everybody.
Thanks for attending.
Thanks,
on behalf
Sally.
of all the Goddard schools.
Have a great night, everyone. Thank you.
Thank you. Have a good night.